What if the best way to get rich in 2026 is to be boring? No crypto roulette, no meme stock drama, no 47 indicator charts. Just a simple, lazy system that quietly builds wealth while you live your life. And today, I'm going to show you the exact autopilot setup. Here's the deal. Lazy investing isn't do nothing. It's do the important things once, then repeat them automatically. In a minute, I'll give you a one-page checklist you can copy. But first, let's define what lazy really means. The lazy strategy is basically 3 rules. Rule 1, invest into broad, diversified index funds or index ETFs. Rule 2, keep costs low. Fees, trading, and taxes matter more than people think. Rule 3, maintain the portfolio rarely, usually a periodic check and occasional rebalancing. And there's a reason this works. Index investing is designed to follow the market with fewer trades, but you still have to understand costs. If you only remember one thing from this video, remember this. Your contribution rate beats your cleverness. Lazy investors don't rely on motivation. They rely on automation, recurring transfers, dollar cost averaging, and a schedule that keeps investing happening even when life gets chaotic. Because the market rewards time and consistency, not vibes. Now, the 2026 Turbo Boost, using tax-advantaged accounts. For 2026, the IRS increased limits, 401k up to $24,500, and IRA up to $7,500. This matters because the lazy strategy isn't just which ETF, it's also the architecture, where your money lives, and how much you're allowed to put there. Simple priority? Capture any employer match if you have it, then consider IRA options, then taxable brokerage if you still have surplus. And yes, details depend on your situation, but the system stays the same. Okay, now the fun part. Most lazy portfolios fall into a few super practical structures. 1 fund, 2 fund, 3 fund, and then I'll show you the 4 ETF covers the world setup. But choose the simplest one you can stick with. Complexity is a hidden fee. Option A is the 1 fund approach, a target date fund. It's basically a pre-built diversified portfolio that automatically shifts risk over time. Heads up, target date funds can be convenient, but costs vary. One reference point mentioned, average target date fund expense ratios around 0.29%. So the lazy rule here is check the fee before you commit. Option B, a 2-fund portfolio, stocks plus bonds. Option C, a 3-fund portfolio, U.S. stocks, international stocks, and bonds. And the maintenance rule stays lazy, contribute regularly, and rebalance on a schedule, like once a year, not based on headlines. No panic, no hype, just process. Now, here's the famous simple build from a major provider. A fully diversified portfolio with just 4 ETFs. VTI, VXUS, BND, BNDX. That's basically stocks plus bonds, US plus international, 4 pieces, 1 global machine. And here's why lazy investors love this. Costs can be tiny. The same research summary notes official expense ratios on fund profiles like VTI 0.03%, BND 0.03%, VXUS 0.05%, BNDX 0.07%. Also, ETFs trade like stocks, and some platforms even allow fractional shares so people can start small. Now, the big question is allocation. How much stocks versus bonds? That depends on your risk tolerance and time horizon. But the lazy principle is pick an allocation you can sleep with and stick to it. Rebalancing is just bringing your portfolio back to the target percentages. But here's a trap. In a taxable brokerage account, selling to rebalance can create taxable events. So a lazy-friendly approach is rebalance on a schedule, and when possible, use new contributions to nudge the portfolio back in line and be mindful of account type. Again, simple system, fewer surprises. Alright, the lazy strategy also has anti-rules. Don't chase what did great last year. Don't trade because you're bored. Don't confuse activity with progress. And remember what regulators emphasize. Even index funds have risks, fees reduce results, and tracking differences can happen. So the winning move is staying in the game. Here's your simple 30-day lazy plan. Week 1, pick your level of lazy. 1 fund, 2 funds, 3 funds, or 4 ETFs. Week 2, Set your contribution schedule. Automatic. Week 3. Confirm your account priority and contribution limits for 2026. 401k and IRA matter. Week 4. Write your rules on paper. When you rebalance, what you ignore, and what would actually make you change strategy. Hint, not headlines. If you want, drop a comment with one word, lazy, and I'll send you a clean checklist format you can reuse for any portfolio. And if this helped, subscribe, because I'm building a full 2026 series where we make money moves without making life complicated. The lazy strategy is simple. Diversify broadly, keep costs low, automate contributions, and stay consistent. You don't need to predict the market. You need to build a system that keeps investing happening, even when you're not thinking about it. This is educational, not financial advice. Do your own research and consider a professional if you need personal recommendations. See you in the next one.